Are you a trader or are you actually a gambler? Because there's a big difference between the two, and in this video, I'm going to break it down. Because I realize that when I read posts on social media, on message boards, on forums, I realize that there are many people out there who call themselves traders. I'm a stock trader, forex trader, cryptocurrency trader, but in actual fact, they are nothing more than gamblers. They are bloody gamblers. They operate from a gambling perspective. Now, I may say, what's the difference and does it matter? It matters. And the main difference between a trader and a gambler is consistency and sustainability. Traders in the long run will always make money and their profits and income are sustainable. They may not make money every day or every week or every month. Yeah, as a trader, you can have losing days, you can have losing months, you can have losing weeks. But as a trader, you find that over time, you will always grow your account. You always make money in a consistent way because you have a statistically proven strategy that is repeatable. Whereas for a gambler, you could make a lot of money on one lucky trade or lucky guess or lucky day, but you find that it's not repeatable. You can't repeat that with consistency. It's not sustainable, and you find that at the end of the day, you will lose everything you made plus a lot more and end up broke. And I've seen this time and time again in the markets. So question again, are you a trader or are you a gambler? Let's find out the big difference in this video. So the first way to distinguish a gambler from a trader are their expectations. What's a gambler's expectation? Their expectation is, you know what, I'm going to get rich really fast. So they think that I'm going to turn $10,000 into $1 million in a year or worse in a month, right? And they're going for that one big trade that's going to be like 1,000% on one trade or a day or month. And they're always looking for that home run. And sure, you could get a trade that makes a lot of money. I don't doubt that. But oftentimes, that's out of luck. And luck doesn't last. So luck eventually will change. And you find that that same greed to get that one big win will also disseminate your account eventually. You're going to bust everything. Whereas for traders, they know that making money in the markets is not a get-rich-quick method. There's no such thing as a get-rich-quick method that's sustainable. It just doesn't exist. All right? Traders know that to get rich, you have to do it consistently and sustainably. And so traders know that to build my account, to double my account or triple my account is not that one trade that could get lucky, but it's doing it over 100 trades, over a year, for example. And I can tell you that I've been trading for many, many years, and I know many professional traders. And you find that in trading, if you can get an average of 5% return to 10% return a month, you're among the best traders in the world. I repeat that, right? 5% to 10% a month is realistic in trading. That means your account will grow at 60% to 100% a year. Now, I'm not saying it's easy. It is not easy. Very few traders can do that. In fact, only the top traders in the world can do this. But the point is 5 to 10% a month. On average, you're getting 60% to doubling your account every year. And that's the best you can get. If you're asking for anything more to double it in a week or month, I'm sorry, you're not a trader, you are a gambler. Second difference, strategy. Traders use a proven strategy or a proven set of strategies that have a statistical edge in the markets. Whereas gamblers ain't got no strategy. Like, what strategy? You guys say, why are you buying this? I'm buying it because I think it's going to go up. I predict it's going to go up. How do you know? Well, because that guy said so in the forum, or because this guy's tweeting about it. And they base a lot of that on luck, right? So if it goes up, wow, I was lucky. If it doesn't go up, it crashes. I was so unlucky, right? But traders know that when they enter, it's not about luck. It's not about making a prediction. It's not about listening to anyone else. They enter trade because of a strategy. So what's a strategy? A strategy consists of a specific set of fundamental and or technical criteria that will give you, the trader, a statistical edge in the markets. For example, a fundamental criteria could be I enter a trade when the stock is having an earnings growth of more than 30%, for example. What are technical criteria? So, for example, I enter when the 50 moving average crosses above the 150 moving average, or when there's a bullish candlestick pattern or bullish engulfing pattern, or the price is oversold, the price is overbought. So, specific criteria that they enter trade that gives them a statistical edge. So what does that mean? A statistical edge means that if you keep using the strategy, you will win more than you lose. And when you win, you will win more. When you lose less. Because there's no such thing as a holy grail strategy. Holy grail means you win all the time. It doesn't happen, all right? So as long as, again, you win more than you lose, and when you win more, you lose less, that gives you an edge in the markets because that generates consistent profitability. So a strategy consists of three main things. Number one would be specific entry rules. When this happens, you enter the trade. When this happens, you exit the trade, either at a profit or loss. And it also consists of specific position sizing rules, also known as money management. In other words, what percentage of my capital do I risk on any trade? And you gotta follow this consistently. There's no such thing as the best strategy in the world because there are many different strategies used by different traders. And some strategies do really well when the market is trending, and some strategies do really well when the market is going sideways and choppy. The important thing is to have a variety of strategies you can use under any market condition. So I've got several strategies that I use that I teach my students in the stock trading course and the options trading course. But some of my favorite strategies would be the trend retracement strategy, where I trade when the price makes a retracement on the uptrend. So for example, an uptrend goes like that, right? Wave up, wave down, wave up, wave down, wave up. During a wave down, we call that retracement. I enter to catch the wave up. That's called a trend retracement strategy. Another strategy I use is called a slingshot mean reversion strategy. So this works well when the price is either on a trend or even going sideways, right? So for example, the price is going like that and it's oversold, and I enter to catch the reversion up. And I'll talk more about that in a while. Another strategy would be the breakout from consolidation strategy, where the price is going sideways, and then it breaks out and you enter on the breakout, all right? So again, for each one of these different strategies, they have got their own entry rules, exit rules, and position sizing rules. So let me give you an example. Let's take a look at the slingshot strategy, or I call it just a slingshot, right? So this is a strategy where these are my entry rules. So I only enter when I've got all these rules that are met, all the stars are aligned, right? So the first rule is that the price must hit the lower Bollinger Bands. So for example, if you look at this chart over here, you can see that the price over here goes down and it hits the lower Bollinger Bands. The second rule would be when it hits the lower Bollinger Bands, you want the stochastics, which is like an oscillator, to be oversold. So you can see this is what we call the full stochastics is oversold. So when it hits the lower Bollinger Bands, stochastics oversold, it tells you that it's gonna snap back up, right? But at the same time, I must be convinced that this is a strong level of support. So it must be a strong level of support. So how do you define a strong support level? Well, it's either a moving average that has been tested before, or a horizontal support level, or what we call a double bottom takeout stop pattern, or a Fibonacci retracement level. So either this or this or this or this. Either one of them would qualify as a strong support. So this pattern that you see is called a double bottom takeout stop pattern. What does it mean? It means the price goes down, makes a first bottom, and makes a second double bottom. We call that a double bottom, and it takes out the stop losses placed by retail traders over here. This is a classic market manipulation technique that was actually taught to me by Alison Chu, who's an expert in market manipulation. And then when we have got the lower Bollinger Bands hit, we've got stochastics oversold, that is when we enter the trade to catch it reversing back up. But before we get in, we want to see a confirmation candle. Like you want to have a bullish candle, full body bullish candle, a bullish pin bar, or a bullish engulfing. So again, you got to meet these 4 entry rules to take a slingshot strategy setup. So if you take a look at this example over here, let me just zoom in, make it a bit bigger for you guys, right? So let's see. Number 1, what happens? We can see, let me just use this pen over here. Number 1, you can see the price goes down and hits the lower Bollinger Bands. Check. Number 2, you can see that stochastics is oversold. Check. Rule number 2, check. Rule number 3, you can see that this is a double bottom pattern, taking out the stop losses of retail traders. Step 3, check. Step 4, we have got a bullish reversal pattern, right? We call this a bullish ice cream bar. So once you got that, you can take an entry, a long entry, to catch the price going back up. So that's one example. Here's another example over here, and this is on EGOV. So the trade setup was right here. So price goes down, okay, hits the lower Bollinger Band, check. Rule 1. Number 2, stochastics oversold. Entry rule 2. Rule 3, it must be at a strong support, a Fibonacci level, double bottom, horizontal support. In this case, it's a Fibonacci level, right? If you look at Fibonacci, you got A to B to C, which is a 61.8% Fibonacci retracement level. Now, if you don't know what Fibonacci is, on YouTube, type Adam Khoo Fibonacci and watch all my free videos teaching you Fibonacci levels. So the point is, we've got all these conditions that are set. Next, we have got a bullish candlestick pattern that confirms it. We call this a bullish confirmation, right? So once we get a bullish confirmation, again, we enter the trade, we enter, and we take the trade all the way up. Now again, as part of the entry rules, you got to have specific points of entering the trade and exit rules. So how do I place orders for the slingshot? So when I do swing trading, I always place 3 orders at the same time. The entry price, the stop loss, and the profit target. So we've got 1 entry and 2 exit points. So in this case, you can see that I enter here. My entry is I put a buy stop limit order a few cents above the bullish confirmation candle. So this is the bullish confirmation candle, and I place my buy order just a few cents above that candle, which in this case is about $22.60. Next, I place a stop loss. Again, remember, in trading, you gotta have a stop loss. Different from investing. Investing is no stop loss because investing is you get married, right? Trading is a one-night stand, it's a swing trade. In one-night stand, you got to use protection. You got to use a stop loss because it could go down instead of going up, right? So we place a stop loss, again, a few cents below the recent swing low candle. That's what we call the swing low candle. We put a stop loss, in this case, at 20.84. So we enter at 22.60 and our stop loss is at 20.84. So the difference between the entry price and the stop loss is called the 1 hour distance. R represents your risk. So whenever you enter a trade, you must know what is your risk, what's your 1 hour, okay? Why? Because then you know where to place your profit target. So the profit target, we want to aim for ideally 2 hours. So you risk $1 to make $2. Of course, you can also risk $1 to make $1.50, but 1 to 2 in this case. So we put our profit target at 25.94. So there we have it. Once we place our orders, we then allow the trade to either hit the stop loss, where it becomes a losing trade and we lose 1 hour, or it hits the profit target and we have a winning trade and we make 2 hours. Now you may say, what is an R? What does R mean? R represents your risk per trade. So again, as part of the rules, we only want to risk a small percentage of our capital on any trade. So usually I tell my students that when you enter a trade, you risk between 1% to 2% of your entire capital. So if it's a losing trade, you lose 1%, winning trade, you make 2% return. Or you risk 2% to make 4%. Now again, if you're not sure how to calculate the number of shares based on that risk, watch this video. Yep, on YouTube, search for position sizing and stock trading strategies. And again, watch this video on how we calculate the number of shares to trade based on a 1 to 2% risk per trade. So if you follow all the rules of a proven strategy, will you always win? Of course not. There's no such thing. There's no such thing as a holy grail strategy that always wins. But again, a strategy will make you rich as long as it has a proven edge, which means again, you will win more than you lose. And when you win more, you lose less. So for example, for this strategy, you find that the win rate is between 50 to 60% win rate on average. So it means that if you take 100 trades and let's take an average of a 55% win rate, that tells you that you're gonna have 45 losses in 100 trades and 55 wins. Now the trouble is you don't know when the wins will come and when the losses will come because they are random, all right? But the important thing is when I have a losing trade, I will lose 1% of my capital based on how I size my position. And when I have a winning trade, I'll win double my risk, which is 2%. So 45 losses, you lose 1% per trade, that's minus 45%. 55 wins, you make 2% per trade, that's 110%. So net, the wins and the losses, you're getting like 65% return on your capital. Now again, this is over 100 trades. They will take about 10 months or a year on average. So that's why I say 65% return a year. It's about 5% return a month. And that is being realistic as a trader. Now again, this is based on conservatively risking only 1% of your money on a trade. So if you're more confident, more aggressive, and you risk 2% instead of 1%, then you will get double this return. You get 10% return a month, or roughly about 120% return a year. Third difference, gamblers take trades randomly. They are like a dog chasing cars on the road, or like they are cat chasing the next shiny object, right? They say, they go to forums, they look for people saying, hey, let's look at AMC, oh, let's go for AMC, or let's go for GME, and you know, they trade randomly based on reading news, listening to people, listening to rumors or predictions. Traders don't do that. Traders, professional traders, don't give a hell shit about what people are saying, about rumors, they don't care about all that, right? Traders basically take high probability trades according to predefined repeatable rules. In other words, they only take a trade if the trade meets all the rules of their setup. And what they do every single day is they've got a routine to screen for trades that meet that specific strategy. So for example, what I do every day is I will use a screener to screen for stocks in the universe that meet my specific criteria. So for example, if I'm looking for slingshot setups, then I would go to my slingshot screen, slingshot, and click on that. And you can see right now today I've got all these stocks that meet that criteria, but I must still look at it manually because it may not meet all the criteria, right? So for example, let's look at the first one, MLM. So if you look at MLM, does it meet the criteria of the slingshot? Let's take a look. So first you can see it's on a very nice uptrend. Now the price is coming down and it hit the lower Bollinger Band. Rule number one, right? Rule number two, stochastics oversold. Rule number three, is it at a strong support level? Yes, it's at a 50 moving average support. This blue line, the 50 moving average, has been recently tested. And that's one criteria of a strong support, either Fibonacci, moving average, horizontal support, or a double bottom pattern, right? So you can see a nice bullish candle there. So this could be a trade to enter tonight to take the price all the way up. Here's another trade, which is, for example, PEG. And again, this is a slingshot setup. Why? Again, price goes down, hits the lower Bollinger Band. Rule number one. Rule number two, stochastics oversold. It just touched it, right? Rule number three, you can see it's a horizontal support level. Support, 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 double bottom. Well, actually, this is a quadruple bottom, but that's fine as well, right? And it's got a bullish pin bar that again signals a reversal back up. So there are many setups that appear every day. I don't take all the setups. I take the best of the best ones. And that's where you learn it through the stock trading course. And of course, I execute it with options as well. Let me show you one last example, which would be J&J, Johnson & Johnson. And again, if you look at Johnson & Johnson, again, price goes down, hits the lower Bollinger Bands, right? Stochastics oversold, rule number two. Rule number three, strong support. You can see this is a strong trend line support. It bounced off, all right? Now, the only thing is we do not yet have a bullish candlestick pattern. So this is not a stock you want to trade yet. But I've already entered this yesterday using options, right? Because I've got a special options technique where with this strategy, my win rate is 90%. I've got a 90% win rate using this strategy called the bull put spread extreme strategy. And the great thing about this strategy is that because it's got such a high win rate, I can enter it even without a bullish candlestick pattern. So if you take a look at, let me show you my account here. All right, you can see, by the way, this account, I do both trading and investing. You can see these are all my positions. I've got a lot of positions over here. But just to show you my trading option positions, let me just do that. There we are, right? So you can see there, I've got DHI, FDS, ISRG, and GNG. I just entered this, in fact, yesterday. All right, and right now slightly positive, right? MasterCard, Nike. So again, all these are ongoing trades that I have in my account. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.